Jonathan Garner is Morgan Stanley's Chief Asian and Emerging Market Strategist. Jonathan, thanks for joining us now. OK, we get 10 straight weeks of gains. It's not a particularly brave call, is it, to say, hey, hang on, we're going to just be pulling back a bit now?
Well, it was maybe a bit braver last December when we went to maximum overweight and recommended being fully invested on the 2nd of December. So, yeah, we've come a long way very quickly. There's still about 10% upside to our year-end target prices, but we're technically overbought. We've had exceptional fund inflows. In those 10 weeks, we've reversed half of last year's outflows. And also valuations are no longer super cheap. We're basically back in line with the long-run average on the forward PE metric.
So where do we go from here, then?
Well, I think we can grind...
Is it a gut check we have, and then we resume sometime later this year?
Yeah, I think we can grind higher towards our year-end target price, but there are a number of risk factors out there, and the one we're particularly concerned about is oil. In this month, in February, oil is up over $10 a barrel on Brent. We're back at about 125, and this is an oil importing region, and that's going to, cause something of a setback, we think, for the markets near term.
Is it not priced in?
No, I don't think so. I think that a sort of potential supply-side shock on oil is very different from a move higher driven by fundamental demand. And this is definitely, in our view, a risk premium, particularly around the Iran situation, which is encountering an economy that is still, relatively lackluster in Asia.
Well, throughout the course of, so far this year, what we have seen, of course, is Greece and the noise coming out of the euro area. But it's been largely shrugged off. Is it because, effectively, we know what Greece and the problems it faces are, as opposed to what Iran is now, because Iran is the unknown factor?
Yeah, and oil is the big new thing, as it were. I would not completely put Greece to bed. There's a lot of loose ends that need to be tied up here. But I think the ECB LTROs was the key moment in terms of actually making sure we didn't have a Europe-wide banking and sovereign crisis. And I think Europe is receding as a risk factor, and at the moment we think oil is becoming a bigger risk factor.
OK, well, that brings me up into the fund inflows you talked about. Is it because of the LTRO that we are seeing these fund inflows?
Well, when we look at QE1 or QE2 and now the hint of QE3 by the Fed, each of those times we had very large fund inflows coming towards Asia and EM. The sequence this time was slightly different. China moved to neutral with its RRR moves first. Then we had the ECB Act. Then we had the Fed pre-committing to zero rates to the end of 2014, hinting at QE3. The Bank of England's done its bit again, and then we've had the Bank of Japan as well. So we actually have 5 central banks simultaneously easing, some of which were surprises to the market. It's hard to think that that could carry on. OK, so what that brings me to, Jonathan, is really talking about what you're hinting at, a crossroads for the markets at the moment. OK, so the thing is, how do you invest? Well, we're making some changes. We have downgraded markets like Thailand and Philippines. They are bigger oil importers. We've had markets that have lagged year to date, Indonesia and Malaysia, that are somewhat more hedged in relation to oil. We've been upgrading those. Those are both back to overweights for us now. And we're very concerned about India, which is a major oil importer. That's the best performing large market in Asia year to date. It began
phenomenal start of the year, but I mean, I guess we were just taking back the losses that we had last year.
Yes, that's right. And we don't actually think the fundamentals have really improved that much on the ground in India on either the growth or inflation side. There's still a lot of political risk there. And now we have this new factor of a surge higher in oil. OK, I'm just having a look here at some of the sectors that you like here. And, where do you park your cash if you're looking at the sector view? Well, we're biggest overweight is energy. And that's not just about the oil price. We think it's a fundamentally cheap sector with higher than average ROE. We've also been picking our spots in areas like software, pharma, and we were in the real estate sector relatively early on, and we continue actually to like that, even though we've seen some strong gains there.
OK, what do you avoid entirely?
Well, we've been funding some of this risk through being underweight telecoms, so that's again a reversal. Telecoms outperformed last year. Maybe slightly more controversial is we've actually moved underweight the materials sector. Some parts of the materials sector, particularly the steels and cements, are fundamentally far less attractive, for example, than those energy stocks I mentioned.
Jonathan, thank you so much for joining us. Jonathan Garner there, Morgan Stanley.